Again, uh, today we will talk about Micron. It's unbelievable, isn't it? Like, I mean, the stock has like almost 13x for me. I created a video a few days ago explaining how my portfolio has almost tripled the American portfolio. Now it has more than tripled. That was like 2 weeks ago. And the idea is that, I started buying the stock in 2023. I could see the importance of memory for AI, and I could see why, spending in AI and inference is not gonna slow down. We were in the very early days. So even if the stock started going up, I bought more. I thought that the fair value of, and we will talk more about the fair value of the business was much higher. And actually, I reached the point that I didn't want to be too exposed, but all the data would tell me that the company is more valuable than before. It was this down cycle that was hiding the AI demand, which was very obvious. So when the stock went back down to 60, I even bought more. So my average is around 80, and with the current stock, like I have almost 13x my money, and I haven't sold a single share. So now the big question is like, okay, what do you do now? You put a relatively big amount of your portfolio there, and now you have 13x your money. Isn't it? Is it the time to you know to trim some of it, to secure some of your profits, or not? So that will be the discussion today. So let's go first here. So one characteristic of Micron, here you see the revenue, the operating margins, and the operating profits. I did that so it's not blurred with sometimes one-off items and that sort of stuff. And it's clear, if you see the history of the company, that the company is cyclical. You see some of the years, the operating profit in the good years was 5%, then it will go deep negative when there was oversupply of RAM, and then again that wouldn't last for long, and then you will have a new upcycle. But every time, as fewer and fewer companies, now it's like it's only Micron, Samsung, and it's SK Hynix that they have survived as the top companies. And you see that every cycle the profit margins are better. So when there is the down cycle, they might have again some bad operating margin, or here like during 2023 you might see even some negative margins, but you see how it has reverted back, and now it has intensified, because that's 2025, the previous year. Okay, so this is the reality, and through this reality, an investor first of all need to always think, a long-term investor, about the value of the business. And the value of the business is not certain. There's always a range. And as I have said many times, the danger here is like in such companies, if the real value of the company, let's say the future profits are such that the real value of the company is, I don't know, 5,000 or 10,000, it will be a huge mistake to sell a compounder. Most of your businesses that you buy will do, you know, average, or they will bring you some profits. And when you hold that business that for a reason um, its value can be 10x, 50x, this can be a game changer for your portfolio. And you have to be very careful not to sell. But also, like if you have a bubble or something and you never take your profits, even that company could, or every company could go bankrupt. So actually, at the end, you get nothing. So how do you navigate on all this? Let me tell you like what would be very easy. So today there was a solar fund that was bought by Drax here in the UK, and this company cannot do anything extreme if you think of it, that fund. So you buy it with a discount. Let's say I bought it at 60% of net asset value, and that goes to 90 or 100. I haven't checked really, but selling there at 100% of net asset value, nothing very bad can happen to you by selling. That's the value of the business is around there, unless Buffett or somebody great takes over. But you don't have to lose much by selling at. Okay, maybe you will leave some profits on the table, but it's not going to be a big disaster. But here, if you bought Micron and you sold at 100, 120, and you were selling a business, we don't know the value, future will tell. And you saw the business that the value probably, I don't know, is 3,000, 2,000, 5,000, we don't know. Like that was a huge mistake, because your investment that would make the big difference for the portfolio, you threw it out. And sometimes the biggest earnings through time come from those 1, 2 outliers, positive outliers. Anyway, so all my thinking is you have to think always both ways. Okay, now I'm in that position, and I'm in this happy position. I'm in this happy position because I hold the company that there are signs that is valued that much. And it's not just because of the stock, and we see like, and we will see now how the profits and everything has expanded further. But the big question here is like, what can I lose by staying here? Let's say if that's a bubble, or if it's a dangerous company, or something reverts back, what can I lose? Okay. And the other question is like, if I sell, what can I lose by selling? Am I selling something? And it's not that this company has another 3 or 4x. If it has something like 3 or 4x more, you have let it already to be a big part of your portfolio. So through compounding, the effects could be very significant, could be a very serious mistake if you sell early. In most cases, by selling, as I said, I gave you an example before, it's not a big deal. For me, selling is, and I created a video. You can check like a few years ago about selling, and I was explaining this idea. But let's go back to Micron. Okay, so now let's go to Yahoo Finance, where we can see the extremes, what's happening right now, right? And we see that for the next quarter, what you saw was based on 2025 earnings, but right now there are projections that for each, you see here the revenue and the earnings per share, right? For next quarter, the average estimate is 20, and for the other quarter 25, and it seems that the company is running, right now the trailing earnings are around an EPS of 100, and it's very possible that the profit margins increase further in this condition. So we will reach even a trailing EPS soon that is 150 or 200. Now, if we go back to this to see that in that perspective. It was here. Yeah. That means that it's that amount of market cap and share price that they are almost identical. So that means we are talking for profits of, I don't know, 100 billion, 150 billion trailing profits. So if you think of those profits, the company is probably trading with a forward P that is close to 10 or maybe under 10 in certain scenarios. So somebody would say, okay, why should I sell a company that trades with a P of, like a company that does very well, a unique company, a company that grows that fast? Maybe a fair P would be from 20 up to 30. And now why you should sell it for 10? And the answer to this one is that when you have cyclical companies, they will have some favorable periods, and then you will have again some bad periods. So possibly those margins that you see now, the operating margins that we have in 2026, possibly are higher than 50%, are much higher than what you see here. Okay, so when you have those extreme profits are not representative of what the company can achieve. But the point is that every time you see that there was a up cycle and a down cycle, you see two things. One is that the company, because now probably it expanded very fast, and because of that there was overcapacity. But at this point that you see those small earnings, probably the capacity of the company, the size of the company, through the profits and the investments that it did, went to another league. It was a step up for the company. And also something else that we see, because possibly the area is becoming less and less competitive, is that in every cycle we kind of see higher margins. I don't say that it will get higher and higher, but it might be. But even if in the next cycle, let's say we have now the up cycle, a new down cycle comes, and then we have a new up cycle. And let's say that a good way to measure the company is to measure it in some more normal margins. And it's very difficult to to make a specific guess. And this is what Monish Pabrai says, that never use Excel, because in those situations the way of thinking might be more important than specific measures putting down to an Excel. It's not bad to put that down, but some things scream at you. So the idea is that even if we have a down cycle and we want to be fair about the company, and this company returns back to normal earnings, they are planning huge investments even in lower margins. Maybe possibly the company can sustain. Let's say if now it can have, I don't know, an EPS of 100 or 150. Now with a much higher capacity and lower margins, that's not scientific. What I'm saying is not scientific, but more or less, let's say it could have earnings after this down cycle from 50 to 100 EPS. So let's put a central power to 75. It might be 50, it might be 20 if things go bad for the company, or it might be 150, right? But I'm choosing this number, which for me it's representative to a fair reality after this step up for the company, right? It will be a much bigger company in production and everything. So if you think of that, I would say that this EPS of 75, it's a smooth value that I can measure the company. And here, because it's a growth company and it has expanded that much, debt and other things do not play any role. And it's a very small debt there. So in this type of company, we are not looking those things at all. They don't matter in this specific company. So we focus on earnings and on growth of earnings. And I would say that with 75 EPS, this company, I might struggle to buy it at 30 if I was not sure. But I wouldn't sell at 30, and maybe I would run to buy at a P of 20. That's 75 that I see now. So this 30, which I would say it might be representative of the fair value of the company on the smoothed earnings, I'm saying, on the future smoothed earnings. That means that possibly a central value that I approach the fair value of the company might be around 2000. And that's not financial advice or anything. It's just the way, and I have to say that, and I should have said that up front, that this is not financial advice. You're responsible for yourself. I've been investing for 25 years, and I'm just telling you the way that I'm thinking in those cases. So I would say that the central fair value that I feel about the company is this one. Now we don't know the future, and as I said, the real range might be from, I don't know, 0 if the company go bust, to 10 or 15,000 in 5 or 10 years if the company becomes the biggest company in the world or something like that. So now the other story is based on that. I believe very much that the inference we are in the very early stages. So I believe the compute and the RAM that we will need it's far more bigger. And there we have scenarios, I'm saying, that could make that company, I don't know, even not having a down cycle until 2020 around 2030, and there even the value is much bigger. And here, just to sum it up, as Buffett has said, it's better sometimes your stocks not to increase in value, because they might entice you to sell. I'm lucky because I could see the underlying picture of the demand and the inference and AI. So even 500, 700, 1000 wouldn't entice me to sell. But if that happened, I don't know, much earlier, and that was not so clear, maybe I would be enticed to sell. So I'm a happy holder of the business, and for me, the value of the business probably is higher than the price that it is now. And I'm happy to hold this business even if the price goes to 2000 for the short term, or it reverts back to 500 or whatever. I'm a happy holder when I know that possibly the value of the company is much bigger. And now, if the market does this thing, let's say, because you have two different things, the price and the value. The value, we don't know it, but it's the value that, I don't know, only God knows, or the future, and it's the value that we as humans assign to and then it's the price. The price is the perception of the market, the perception of the people. So the people now recognize Micron. Maybe Micron was not very different 3 or 5 months ago, but the market didn't recognize it. But let's say now the market recognizes it and it goes to 2000. Okay, what I'm doing then? So this is where I will see again the data, and this is where my analysis, because now, when I see that possibly the value could be very possibly 2x, and it could be even more, I'm not even thinking of selling. And the only issue is that it's becoming bigger and bigger part of the portfolio. It's something that I'm worrying about, but I cannot and I shouldn't sell at this point when I think what I believe in the company. But if the company tomorrow reached 2000, I should sit down and think carefully. Now I say, okay, it's a company that maybe it's close to the fair value. Maybe I could take some of my profits, just in case, some of my profits. It depends also if I can find other opportunities. So that's why I'm saying I would go and reevaluate the situation carefully, because maybe down there, I don't know, the earnings have increased to 200 or 300 EPS. And there, even if the stock is 3,000, I wouldn't sell. But right now, if the stock was at 2,000, I should think very carefully. But at this moment, I'm not saying that the value of the stock, we don't know. You know, that's how investing is. And most of the experience is not about, some of it is about the analysis. What I told you, for this business, that doesn't matter. You know, sometimes people just learn a certain way of thinking for each company. But you need to understand that for each company, you need a different type of analysis and a different way of thinking. So I'm explaining to you how I'm thinking about this company. And yeah, we don't know what will happen. So we're trying to navigate. The job of the investor is mostly that type of you know, of philosophy on how they will deal with those things. Like the person that, for example, got into Micron and then started buying, selling, whatever. I don't think that they would get this 10x, right? Or a person that is just so, okay, 100% earnings are high. They just look at the graph and they say, okay, I will guess, you know, by the graph. You know, I personally don't believe that those things work. Maybe they work for very few people, that they have a very different philosophy. But yeah, that's the idea. So I'm saying that, and I know that in 1 year from now, we might see, I don't know, a disaster in semiconductors, whatever. Everything is possible in life. I might be wrong that I didn't, you know, trim some of my positions, but I don't think it's the right thing to do right now. And I think it's the right thing to do, to just stick with it, you know. It's like, I'll just say this and then I will stop. It's like you have the tree, and now you see that this tree is producing gold, you know. And this is the thing. Now the market has started realizing it. You know, you're not selling this tree. You don't know if you will continue producing that gold, but when you see that tree and it starts producing the gold, you are very lucky that you picked that tree. You don't sell that tree right now. And yeah, another story, but possibly for another video, is like why I believe that inference will explode. We have inference could be 10x bigger than today. I don't know, 100x bigger than today. That's another factor. But yeah, that's it. You know, if you like the video, you know, subscribe to the channel and like it and share it if you find it educational and useful. Yeah, thank you very much. Bye bye.